The history of money is engrossing and goes back decades. From the early days of the barter trade system to the first metal coins and eventually the foremost paper money, money has always had a vital impact on the way we function as humans. In this flick, we'll go into fact about the history of money and how humans have advanced from the barter trade system economy to a complex financial system with several forms of money. If you are new here, consider subscribing so that you don't miss another interesting video like this. Impressively, money often has no internal value. Rather, money is a specialty that has a value placed on it, which allows for the business of goods and services. Most money, such as metal coins, has real value in terms of the materials used. Nevertheless, paper money is more common in the modern world and naturally has no real value. Through the evolution of money, the currency has taken several different forms. The creation of money. Before money was brought into existence, people bartered for goods and services. It was not until about 6,000 years ago that the Mesopotamian people created the shekel, which is considered the first known form of money. When stamped coins were used to pay companies. What was used before money was created? When there was no money, people traded goods and services for what they needed. One farmer might trade meat for vegetables, while another may trade labor or wood for bush meat. These agreements were the early building blocks of our modern economy and would go on to build the future of money the world knows today. Barter trade system. The history of the barter trade system dates back to about 6000 B.C., when Mesopotamian tribes introduced the concept to the Phoenicians. Goods were exchanged for each other in the absence of money, including things like porridge, salt, weapons, and food. As time went on, the barter trade system continued to grow up. First metal money, coins. The first metal money dates back to about 1000 B.C. These coins were made from stamped pieces of valuable metal, such as bronze and copper. An early repeat of coins was used by ancient Greeks. Over time, these coins would grow up to be made from the silver and gold we associated with money today. Coins were a huge landmark in the history of money because they were one of the first currencies that allowed people to pay by calculation rather than weight. Early coins. Through the records, there have been lots of different coins used in different environs. In about 500 B.C., the first round of coins was created and stamped with gods and emperors for authenticity. In 800 AD, Charlemagne issued the silver penny, which was the standard coin in Western Europe from 794 to 1200 AD. In the mid-13th century, the shilling and pound became widely used to describe larger amounts of cents. As the value of capital has changed over the years, the creation of larger forms of currency has been an important part of the history of money. First paper money. Meanwhile, the first paper money was created in China in 700 to 800 AD. It would be a long time before the paper cash was commonly used. In some cases, the first country to use paper money was China, but it was only used until about 1455. The lighter weight of paper money allowed for international trade, which created both issues of doubt and currency wars and the opportunity of the ability to trade in new places for new goods. Later China stopped using its paper money during the mid-15th century. Coins once again became the most popular form of money in the country and the world. Bills of exchange. Bills of exchange became a common part of the world economy. A bill of exchange is practically a written order that one person or group will pay a specified amount of money on demand. A bill of exchange can be used to settle an account in international trade, which was one of the early uses of this order. Currency wars. The creation of paper money would eventually lead to currency wars, which occur when leaders of different nations try to lessen their currency. In return, this boosts demand and helps stimulate their economy. While this still occurs in today's foreign exchange market, the signature of a currency war is the fact that several nations are involved in the devaluing of other nations' money. Nonetheless, Currency wars can have adverse consequences for the countries affected. The opening of banks. The first banks were started by the Roman Empire around 1800 B.C. These banks offered loans and accepted deposits from the people, but later disappear with the collapse of the empire. By the turn of the 19th century, banks had become respected organizations within communities and learned the concept of fractional reserve banking. Since some people did not withdraw all their money at once, banks learned that they could loan more money than they had, which was a huge step in the history of money. The first bank in the U.S., the Bank of the United States, was established in 1791. The gold standard. In 1816, gold was made the standard of value in the country of England. What this means is that each money represented a certain amount of gold, so only a limited number of money can be printed. This gave previously unbacked currency some semblance of value and stability. By 1900, the United States had followed claim with the Gold Standard Act. While this would lead to the U.S. establishing the central bank that plays an important role in the economy today, the gold standard ended in the 1930s due to the depression and the devaluation of gold, modern-day money. Now that you have a better understanding of the history of money, let's take a look at how it is used today. Now, money has been put up in the form of everything from the U.S. dollar to cryptocurrencies like Bitcoin. Appreciation to the creation of modern-day money, selling, buying, and trading is easier than it has ever been. Debit cards and credit cards. When it comes to convenience, credit cards and debit cards are prevalent choices. A debit card is loaded with a set amount of money from your bank account, with money being removed from your account after each purchase you make. Credit cards are a little different in the sense that they don't carry a balance that you have to put in. Rather, lenders can choose a credit limit to set on your card, allowing you to spend up to a certain amount before you have to start paying it back to continue using your card. Credit cards were first issued to consumers in 1958 and have grown in popularity ever since. Some years later, credit cards were the most commonly used payment method in the United States.